The next big Forex move might not start with the Fed. It could start with oil. Because when oil moves hard, it can change inflation expectations, bond yields, and rate expectations before a central banker says a word. And that's where Forex traders get caught. The chain. Here's the chain. Oil rises leads to inflation expectations rise, leads to bond yields rise, leads to rate cut expectations change, leads to currencies reprice. That's the part most retail traders miss. They watch the Fed. But the market can start pricing the Fed's next move before the Fed actually moves. Why it matters. And don't assume oil up equals dollar up. It depends on who gets hurt and who benefits. For an oil importer, higher energy costs can mean higher inflation, higher import bills, weaker growth. For an exporter, higher oil prices can mean stronger export revenues. So the real question isn't, what is oil doing? It's, what does oil change about each economy's outlook? What to watch? If oil suddenly spikes, watch 3 things. Oil, 2-year bond yields, rate expectations. If oil rises and yields barely react, the inflation signal may be weak. But if oil rises, yields jump, and expected rate cuts get pushed back, now you've got a real macro repricing. And Forex can move before the central bank does anything. Don't trade the oil headline. Trade the chain reaction. Oil to inflation, to yields, to rates, to Forex. Because the next major currency move may already be developing before the Fed ever speaks. Subscribe to MarketsVox if you want to understand what's actually moving Forex, not just react to the headline.